All right, let's jump right in. We're tackling one of the biggest puzzles in finance today. You've got the stock market hitting all-time highs, just soaring on this incredible wave of AI optimism. And yet, at the exact same time, a lot of people are feeling this deep anxiety about the economy. So, what's the deal? What is really going on? This quote from a recent CNET report just nails it, doesn't it? It perfectly captures that feeling. And it's this exact gap between the exciting story the market is telling us and what many of us are actually experiencing that we're going to unpack today. So here's how we're going to break it down. First, we'll look at the case for this AI boom being the real deal. Then we'll flip the coin and look at the warning signs of a bubble. We'll also get into why the market is so concentrated, search for where there might be some value, and wrap up with how to think about playing the long game. Okay, let's get into part one. Why are the markets so hot right now? Well, the bullish argument is that this isn't just smoke and mirrors. No, they say it's being driven by some very real, very powerful forces they call micro-tailwinds. The first piece of evidence? Corporate earnings. And they are, to put it mildly, phenomenal. We're not talking about a small beat here. We're talking about a massive 33.7% earnings per share growth for the big tech companies in the NASDAQ 100. I mean, that's not just good, that's an absolute blowout. And this isn't just a tech story. The strength is pretty much across the board. The S&P 500 has now seen its third straight quarter of double-digit earnings growth. A huge 81% of those companies beat what analysts were expecting. And maybe the most telling thing, companies are actually more optimistic about the future than they've been in a good long while. The second pillar here is just the staggering amount of money being poured into this. Get this, just 4 companies, Meta, Microsoft, Amazon, and Google, are set to spend $350 billion on AI stuff this year alone. That is more than double what they spent just back in 2023. This is real cash, and it's not just staying in Silicon Valley. It's flowing out into the wider economy and driving actual growth. But for every bull, there's a bear, right? So now let's look at the other side of the argument, the macro headwinds. Because despite all those strong corporate numbers, there are some serious red flags that are giving seasoned investors a major sense of déjà vu. And this really brings us to the fundamental question posed in that CNET report. Is this time really different? Is AI truly the dawn of a whole new economic age? Or are we just watching the latest remake of a very old movie about tech euphoria and the inevitable crash that follows? When you start looking at some of the classic valuation numbers, those warning signs get a lot brighter. The Shiller PE ratio, which is a great way to get a long-term view by smoothing out earnings, is more than double its historical average. Then there's the famous Buffett indicator, which compares the stock market's value to the size of the entire economy. It's at a record high. And the equity risk premium, basically the extra reward you should get for risking your money in stocks, it's razor thin. These aren't just abstract figures. They are all flashing a warning that the market might be getting into some dangerous territory. And as you can see here, we've been down this road before. It seems like every few decades, some groundbreaking new tech comes along, captures everyone's imagination, and leads to a wild period of speculation, which, well, often ends in a painful bust. From radio in the 20s to the dot-com bubble in the 90s, the pattern is just eerily familiar. I love this analogy because it illustrates the risk perfectly. Back in the late 90s, telecom companies spent billions building out 3G networks because they just knew mobile data was the future. And they were right. But they were about a decade too early. The iPhone hadn't happened yet. The fear today is that we're doing the same thing, building this massive, expensive AI infrastructure before we even have the killer apps that will actually use it all. And that really gets to the heart of the bearish case. The argument is that stock prices may have totally detached from the real growth we talked about earlier. And now they're just floating on a story, on the pure, simple belief that AI is going to change absolutely everything, starting tomorrow. This leads us to another huge worry, and that's just how concentrated the market is. I mean, this entire rally is basically being held up by just a few giant companies. This concentration risk is like pouring gasoline on those bubble fears we just talked about, and it creates a whole new layer of potential problems. So just to put this into perspective, take a look at this. At the very peak of the dot-com bubble, the 10 biggest stocks made up about 27% of the S&P 500. Today, that number is over 40%. The market is way more top-heavy now than it was during one of the biggest bubbles in modern history. And here's where it gets kind of weird. While those top 10 stocks make up over 40% of the market's value, they only contribute less than a third of the total earnings. What that means is their influence on the market's price is way bigger than their actual share of the profits. and that creates a real point to fragility. So what do? You've got these two incredibly powerful, totally opposite stories. On one side, you have amazing tangible growth. On the other, you have all these historical warnings about a bubble and this crazy concentration risk. So what's the path forward? I think this quote from Morgan Stanley just says it all. We're in a period where visibility is super low. The range of what could happen next is just incredibly wide. This is definitely not a time to set it and forget it. It's a time to be paying very close attention. Which, of course, brings us to the big practical question. Given all this uncertainty, what are some smart ways to think about strategy? So here's one possible approach. The CNANet report lays out this idea of rebalancing. It suggests maybe dialing back your exposure to the super concentrated US market a bit, while maybe looking at areas like Asia, which has a pretty compelling long-term growth story. And here's the key. The idea is to keep a good chunk of your portfolio in fixed income. Not because you're scared, but so you have that dry powder, cash ready to deploy to jump on good opportunities that might pop up if the market corrects. Of course, look, this is just one take. The right move for you totally depends on your own personal goals and, how much risk you're comfortable taking. Okay, so this really all comes down to one crucial mindset, a way of thinking that can help you play the long game in an environment like this. It's this idea of strategic humility. What does that mean? It means you can be a total, true believer in the long-term promise of AI while also acknowledging a simple historical fact. These big transformations are never, ever a smooth, straight line up. They're volatile, and the road is almost always bumpy. And I just want to leave you with this one last thought. The time to be cautious isn't when people are nervous and worried. It's when everyone is sure. It's when confidence becomes consensus. That's the moment when the smartest people in the room start getting ready for a change. The goal right now isn't to predict the future. It's to be prepared for it.